Every December, Wall Street releases hundreds of market predictions, confident outlooks from banks, asset managers, and economists about what the market is supposed to do next. There are years when major banks predict double-digit gains and the market barely moves. There are years where recession is the dominant forecast and markets deliver surprisingly strong returns. And there are years when everyone agrees on the outlook and still gets the direction wrong. That isn't rare, that's the pattern. Market predictions have been around for more than 100 years, and they've been wrong for just as long. This isn't a modern problem. It's not social media or cable news. Newspapers were publishing confident market outlooks in the early 1900s, and they were just as sure back then as they are now. Every generation is convinced its uncertainty is unprecedented. It never is. In the 1920s, people believed markets had entered a permanent boom. In the 1930s, people believed capitalism was finished. In the 1970s, inflation was supposed to destroy stocks forever. In the 1990s, stocks were considered guaranteed winners. In the 2000s, stocks were declared dead, then resurrected, and then declared dead again. And somehow, markets kept going. Here's another uncomfortable but consistent truth. Analysts are just as bad at predicting booms as they are at predicting crashes. Periods of extreme optimism often disappoint, while periods of fear often produce stronger than expected returns. What makes this even more interesting is that today we have more data than ever before. Real-time information, AI models, global data, and thousands of professional analysts. Yet market prediction accuracy has not meaningfully improved. And the reason is simple. Markets don't move on information that's already known. They move on new information, and new information is unknowable by definition. That's not pessimism, that's math. That also explains why predictions tend to get more confident when uncertainty is highest. Confidence sells, certainty gets clicks, and we don't know doesn't. There's one more historical pattern worth noting. Some of the market's strongest years follow periods when expectations were very low, while some of the most disappointing years followed periods of extreme optimism. Markets are forward-looking. Humans are backward-looking. We react to what just happened, while markets react to what surprises us. This is where stories get us into trouble. Rates are high, so stocks must fall. This technology changes everything. The election will decide everything. This time is different. Those are good stories. They sound logical, but markets don't reward good stories. They reward probabilities playing out over time. One of my favorite nerdy lines is this: if predicting markets actually worked, it would stop working the moment everyone believed it. That's how competitive systems behave. When you zoom out and look at history, something becomes very clear. Markets don't reward foresight. They reward participation. Volatility in both directions isn't a flaw in the system. It's the price of admission. I've been saying stay the course for about 15 years now, not because I'm optimistic, but because history is brutally consistent. History doesn't show us how to predict the next year. It shows us how little prediction has ever mattered. That's it for this week. This is Jeanne, the 401k lady.